Hey, Josh, good morning. Good to see you today.
Good morning to you.
Yeah, so for anyone listening and watching this, I want to make sure they know who the great Josh Flores is with Supreme Lending. I think we met maybe back in 2006.
Yeah, it was quite a while ago, but that dates us, so you're not supposed to say things like that.
Tell me a little bit about where were you at in your career at 2006?
So I had finished college in '02, and mortgages was the first thing I went into. I was a finance major, did small business, did marketing internships, and mortgages kind of allowed me to mix several of those things together, right? I didn't like either one of the or any of those industries individually. So, and I love sales and I love talking to people and all that. So it was a good mixture. So I started with a company in '02. So by '06, I was 4 years in, and honestly, working with the group that I'm with now, I had already started at that point. So the group I'm with now, we've been together since, gosh, I think it was right end of '05, I think is when I started working with them. And now we've, gone the distance, created a branch, and been a brand and all the rest. So it's funny, I never grew up as a young boy dreaming of being a loan officer one day, but I mean, I kind of ended up in this world, and it's been great. So
How many deals would you estimate we've done together?
oh, I mean, lots, over 100 easily, right? I mean, so
Hard, right?
I haven't actually sat down and counted them before, but yeah, many over the years for sure. So
You might have an easier system where you could actually go and to look to see how many deals you've done with me. I really don't have a way to go back in and cross check that. So that would be fun to do someday.
I should go run that report at some point. So, I have switched over from a few different sides of the real estate industry, or the mortgage industry specifically. So we've been on the broker side, we've been on the banker side, and it's interesting to know that not all mortgage banks are built the same, right? There's different types of us out there, and I think where we've landed now is ideally where we want to be, where you can have your own underwriting, have your own processing, have the control and the control over pace, control over guidelines, control over that, and then also be able to price across different banks out there. So, and the advantage of the broker and the advantage of the banker all kind of together in the setup we have now. So I like it.
I would want to highlight one more thing to that is that a lot of my clients, when I'm sending them to you, one of my, biggest pitches and reasons why I really want them to go and work with you is because you also can control the customer service end of it. And if my clients go to maybe a builder's lender or big bank, those people aren't looking to build relationships, and you're always looking to build a relationship with my clients for forever.
That's such a big deal, their responsibility at a builder is to the builder, right? And now they're supposed to be representing you, but they have an agreement with the builder, and that's everything to them, right? I mean, if you don't come back as a client, that's not really a big deal to them. Their client is the builder, and that's who sends them, business, if you will. So yeah, I mean, that's something that I talk about all the time. If you're going to a big online, for like a Rocket Mortgage or something like that, those guys, they're just marketing, right? They send out the clickbait, they try to snag you in, and whether they do a good job or not is not really that important. They just want to get it done and move on to the next person that they snag online, so relationships in this world are a big deal, because as on the real estate side too, you have partnerships with inspectors, with all the different people out there that you need, termite, sprayers or handymen or whatever it happens to be. And gosh, Lord knows there's a lot of bad contractors in the world. So it's always good to have the inside track to good referral sources. So
I'm wondering, do you happen to know for your own self with the business that you do, we'll just say on an annual basis, what percentage would you guess is by referral or repeat versus someone just maybe organically or accidentally finding you?
Well, I'm lucky to say it's a very high percentage at this point in my career, right? I mean, it would be 80+% of which is, folks that are either preferred or coming back to do another mortgage, buy another house, or refinance, or whatever it happens to be, which is a good stage to be in because you know them, right? And it's always nice to reconnect with people. Hey, how's things been going? You know, gosh, I mean, it's funny in our world too. And you know this even more than me. It's like you play psychiatrist a lot of time, right? You learn so much about these people. A lot of times they become your friends. You're now sharing social media together, and you kind of follow each other's lives, and then they come back to you and do more business together. And hopefully, a lot of times, if they're self-employed and run their own business, we do business with them too on a personal basis,
Right,
so
right.
how many times have you met a client, became friends, and then used their services, so it just builds that circle. So it is nice. But yeah, that's we're always looking for new business, of course. We're always looking to expand and meet new people, but referrals, especially, not just them coming back, but their friends, their family, that's a big deal for us. So
I always like to say cool people know cool people.
yeah, that's right.
Yeah.
And we better do a good job, right? Because they won't come back if we don't.
So you went to St. Ed's, is that right?
I did. Mm-hmm.
Yeah. And I like that about you. When I first started working with you, I remember sitting in your office, and I think John had made some kind of a spreadsheet. And I just remember thinking, man, this is so cool. I that might have even been a turning point in my career, because I realized how much I liked the numbers.
Yeah.
And that's something I really like about you too, because you understand where the numbers are even coming from. And that can be really confusing for most people. So I'm going to give you the floor, and you can tell us a little bit about where are these numbers coming from and what's happening right now.
Yeah. And just to hit on that a little bit, I mean, that's one of the things I try to do for folks, specifically like first-time home buyers, especially, is you're trying to explain the why, right? Like, not just here's your payment, but here's what it's made of. Here's why it equals that. Here are the different parts of it. Here's how it can change, right? If taxes change, if insurance changes, if HOA changes, or whatever the case may be. Because a lot of the frustration in real estate is derived from just not knowing what's going on, right? Like expecting one thing to happen and something different happens, right? So if you kind of understand the entire process, you know what to expect, what can happen, you're prepared for it, and so I think it really helps. So, so when you talk about numbers and whatnot, I assume you're kind of referring to what's going on with the market, what's going on with rates. Is that kind of where you're going with that?
Yep.
Yeah. So I think to understand where the market is and where it's going, you have to understand a little bit about where it's been, right? Like, so specifically, we're in a very unique time, right? Coming off of a pandemic, economic, what could be considered a crisis at that point, very different. So if you get just before this global pandemic thing happened, Austin in general, Central Texas, really a lot of Texas, but Central Texas specifically, had been doing really well, real stable, real consistent growth in terms of equity, a lot of jobs being created, a lot of population growth, which increases demand, which is increasing equity. All of that was happening on a very regimented basis. I mean, you had, going all the way back to 2008, the last housing crisis that occurred, we made it out fairly unscathed. I mean, Austin is just kind of this little economic bubble that does pretty well. And so then fast forward to when coronavirus hits, right? Everybody kind of says, "Uh-oh, what's going on?" Everybody kind of pauses for a couple months. The whole world paused for a couple months, right? Trying to figure out what we're going to do about this. Including the government, including the Fed. And so as it comes to mortgage rates, and specifically the real estate market, we saw rates being somewhere in the 4s and 5s at one point beforehand, to dropping down to now the 3s, and then starting to dip into the 2s. Well, what a lot of people maybe know, but probably don't in some cases, is really, why did that happen and how did that happen? Okay, so when an economic crisis of that size occurs, the Fed starts stepping in and doing lots of things to help people, right? So you saw stimulus checks, you saw what they call PPP loans, which is helping small businesses, and just lots and lots of money going out. Well, another huge one was something called mortgage-backed securities. So the Fed started buying into mortgage-backed securities. to the number of over $1 trillion. So we're not talking about small numbers. We're talking about very, very large numbers. Mortgage-backed securities are kind of a complicated thing, but as a mortgage is originated here, basically it goes up a chain and eventually becomes what's called a mortgage-backed security. And there's a value to that. Well, as mortgage-backed securities become more valuable, that's when rates drop. And so when they're dumping trillions of dollars to buy these securities, that's what artificially pulled rates down into the threes and then eventually into the twos for a bit. And the reason they did that was to help people out, right? So everybody could refinance, everybody could keep their mortgage payments low. We knew the housing sector of the economy was going to be just fine. And so you had now people seeing all these really low rates. And so activity starts really churning up in the mortgage world and the real estate world. And it wasn't just refinances, it was actually purchasing of houses at that point. Well, as you can imagine, the demand far outdid the supply. And so then you just have this equity growth where there's too much demand, not enough supply. But you also have money being created into the market. So like when the government says, hey, I'm going to send a stimulus check or do a PPP loan, it's not like they're going to their savings account and pulling money out. They're printing it. So they're just creating money. And so when you inject all this money into the market, now you have too much money chasing too few goods, which is the definition of inflation. Okay. So then we start seeing inflation getting worse and worse and worse over the course of that time. Last year specifically was the worst of it. That's when we really started seeing it getting out of hand. So what does the Fed do? They take money out of the market. So instead of putting trillions into mortgage-backed securities, instead of sending out stimulus checks, stop all that. And in fact, they go backwards. So a security, when you purchase it, is actually an asset. And so on the Fed's books, they had assets. So instead of spending $1 trillion on these, they're actually selling them back into the market and getting all of their money back is what they're doing. Stop doing any stimulus checks. They stop doing all this stuff. They're just pulling all this money back. So what that does, and couple that with the Fed rate increasing. The Fed rate is not the mortgage rate. So those are two very different things, but they do play in the same ballpark, if you will. So they have an effect on each other, basically. So as the Fed rate increases, that means big businesses are no longer taking loans. So they're not creating jobs because they're not taking a big loan to start a new business, hire a bunch of people, and then pay those people. Everything kind of slows down, basically, right? And that's the whole point of stopping inflation, is to slow everything down. And that started, probably about June of last year, something like that is when everybody,
I think.
yeah, I mean, you really,
I feel like I remember the day.
yeah. I mean, it really started happening at that point, and then just happened really, really fast. And so rates go from 3% to, we saw rates spike above 7 in some cases. And now you're starting to see inflation specifically getting better. So what the Fed is doing is trying to offset inflation, and it's working, right? So we're seeing data that suggests it's working. There's something called CPI, which is Consumer Price Index. There's several different measurements of inflation, but that's kind of the main one that people look at anyway. And every month, a new CPI number comes out. And so when you talk about, you probably saw like 8% inflation, what that is basically every CPI number for the last 12 months, they add them together, and that's annual inflation. And I'll try to explain this without boring you to death, I promise. So just know it gets more complicated, but this is kind of the high level viewpoint of it. So we're already seeing in November, December, and January, we're already seeing better and better numbers coming out with CPI. The one number that is kind of hurting CPI within that calculation is shelter, which is rents. A lot of times rents have been kind of going up, and that's part of that measurement, that the cost of living, right, in the US. And so we're seeing better numbers coming out. We're seeing downward pressure on rates. One big date to remember is May 10th. That's going to be another date where CPI is released. But that's when you compare last year's shelter, specifically shelter costs, rent costs, you see that they're really high in April and then going into May and June. And so when those April, May, and June numbers are released, that particular section of CPI is going to be a lot better, mixed with the fact that overall inflation is also coming down. So once we can really show that we've got it under control, that's when you'll see rates continuing to drop at that point. But we're already seeing it happen, right? We're already seeing that downward pressure. And I think, kind of what we talked about. People are always trying to time, like, when should I get in the market, right? When should I buy a stock? When should I sell a stock? When should I buy a house? When should I sell a house?
Right.
It all happens very quickly. And so, we're already seeing more applications. We're already seeing more buyers that are getting off the fence at this point. And I'd love to tell you, we have developed a lot more supply, right? Which is a good thing. We have more supply out there. So for buyers, if you want to go look for a house, you're not in line behind 40 other people having to make an offer in 0.3 seconds. That's $100,000 over asking price. That's no longer the case, right? That was the huge problem with before. It's like, yeah, that's great. Rates are low, but I'm spending $100,000 over on this house just to get it. Otherwise, I didn't get it. So if you really wanted it, you had to be aggressive to get it. And even those folks that did, you'll get your equity, right? Like, you live in the house long enough in this area, you're going to get your equity back and you're going to win overall, right? But now the advantage is you can get houses for less. You have a little bit higher of a rate, but always keep in mind, the rate is not forever. The rate is not forever. It's only until you can refinance it to something lower. And one of the big advantages of sellers these days is they'll actually pay to get your rate lower. They'll pay to buy down your interest rate as part of the negotiation of buying the house. And so, all these little tricks to financing, all these little tricks that we're doing now, help you get into a house now for $50,000, $100,000 less than you would have. That's real money, right? That's real cash. And then they can temporarily keep your rate down for the next 2 years while we wait for the market to continue to calm down in terms of rates. And then from there, we refinance you down to something. We're hoping by the end of the year, I'm hoping low fives, something like that would be kind of average, just as a ballpark par rate. We're not going to see rates down in the 2s or 3s again for a very long time, not without another massive economic crisis, which
Let's hope that doesn't happen.
Nobody's really rooting for that. Yeah, exactly.
I was listening to something that Robert Refkin had put out, the CEO of Compass, and he was talking about currently, right now, is the single greatest time to be a buyer in light of the concessions that you can get from any seller, including builders, in the last 10 to 15 years. I'm certainly seeing that. It's really quite nice, but tell me, from your standpoint, when you're seeing those concessions for a buyer that you and I are working with, what are we using? What are we using those dollars for? Like, specifically, how do we use those dollars that we can get from the seller?
So the most popular use of those dollars currently is doing what's called a 2-1 buy down or a 3-2-1 buy down. Okay. So, again, trying to explain some of this in a very short amount of time, you could do traditional buy downs, is like, maybe viewers have heard of points, right? Paying points to buy down an interest rate. 1 point is calculated as 1% of your loan amount. And that is
that always true? 1 point is 1%?
Correct. Yeah. That's always the case. And so 1% of loan amount, not of sales price, but of whatever your loan amount is. So, in those cases, in a normal market that's not as fluctuating as what it is now, those are permanent buy downs, right? Now, you pay 1 point, it maybe moves your note rate down by, say, 0.25%, right? So it's not as dramatic of a move, but it's long term. And long term changes on a loan matter when the plan is to be in the loan long term. Okay. But when we're in a market like we are now, where things are up and down, at the moment, these loans that we're doing right now, you're not going to be in for 30 years. I mean, in almost any market, you're not going to be on a loan for 30 years, really. But most people hold houses for 5 to 7 years, I think, is about the average. But more importantly, we're just concerned about the next 2 years. And so these buy downs and this seller concessions that sellers are offering, which they did not offer in the past, in fact, it was kind of opposite, we're using them for what's called temporary buy downs. So, like, let's say that the par rate currently is 6%, right? Just for a normal 30-year loan. Well, you do a 2% buy down. What the seller does is we move the rate down to 4%, from 6 to 4, so 2% lower for the first 12 payments. So the first year, excuse me. The second year, it goes up to 5% for 12 more payments. And after 2 years is expired, it goes to the regular rate, which is 6 for the rest of the time. And the difference in the payment during that time is the buy down cost that the seller pays for you. Okay. So again, pros and cons of the market right now. I can get the house for cheaper. Oh, but the rate's higher. Okay. Well, here's the strategy there. Have the seller pay for it. And the sellers are
Right.
willing to do it because they want their house to move. They can provide that money. And there's even more to the beauty of these buy downs. Let's say rates do drop in a year. Something dramatic happens and the rates drop, and you haven't used all those funds that are in that buy down account. You get them back when you refinance it. So they literally give it to you in the form of what's called a principal reduction. So meaning like if your loan balance at the time was 400,000 and you had 10,000 left in that account, now your loan balance is 390 when you do a refinance, when you pay it off. So it's a great idea because people get stuck on the rate, and the rate matters, right? The rate plays into the payment. It matters in terms of what you can afford or what you want to afford, right? But if we can get it down in the meantime, you have to see the future, right? Like when you buy a house, it's not a temporary thing. You have to see it over the next 5 years. It's an asset. You're looking for it to perform just like any other asset, just like any stock, just any market asset you might have. You're kind of always watching it. You're not looking to buy and sell it. Some people do, right? Like flipping houses and that kind of thing. But that's a whole separate conversation. Most people in real estate are going to buy and hold for at least a section.
How do I qualify for the house from a lender's perspective? When you're qualifying me to buy a home, are you looking at that affordability at a 4% interest rate?
We're not. So you qualify at the high rate, right? You qualify at the actual rate. So they have to be able to afford it at the 6. And that's prudent, right? I mean, assuming, strangely enough, the market, something else happens and the rates stay high for some reason, which is highly unlikely. But the fact is, underwriters are always looking at things from a worst case scenario viewpoint, right? So now things can change. I mean, we definitely know that. So in other words, you could be a salaried employee and quit your job tomorrow, and go somewhere else right after we fund the loan. We totally understand that, but we kind of take a snapshot in time that is prudent, and that even applies to like people have probably heard of ARMs or adjustable rate mortgages. Whenever we qualify for those, we're also qualifying at kind of the max rate that it can get to, just to make sure you're protected. They don't want to put you in anything that's going to, create a massive problem for you down the road is the idea there. And that's a strategy that really was born after 2008, the most recent housing crisis, where it was like, it just wasn't smart to put them in a loan and just assume that the rate's always going to be really low. That doesn't really make sense. Like you kind of have to look at it from a different standpoint. And that's why in today's world, even with everything going on, there's not going to be a housing crisis, right? Like who is going to let their house go to foreclosure when they have all the equity that they developed in the last 2 years, right? They have a 2.5%, 3% rate. They have all this that they're going to, first of all, they would sell it. If anything really goes bad, they're just going to sell it because they could walk away with hundreds of thousands of dollars, right? And so you have really low rates that are fixed, not adjustable, not anything getting crazy on them. You have a lot of equity. And so the foreclosure crisis is just it's just not going to happen, right? Now, if we do fall into a recession or something like that, and people have to move jobs and whatnot, you'll see some turnover of those houses, but again, not foreclosures, very different. So, and by the way, this is going to sound bad. Recession is actually good for mortgage rates. So that's another thing I actually like to bring up, because some people are concerned about if we're in a recession, how bad a recession, that kind of thing. In the same way, if we do fall into one, which I believe will slip into some version of a recession over the next year or two here, right? I don't think it's going to be bad, but I think it's going to be a version of a recession. If that happens in the same way that the Fed kicks in and helps American citizens at times, homeowners at times, historically speaking anyway, they step in and they bring rates down again, because that helps kind of bolster the economy as a whole. So when people are struggling, it helps them. So
if your timing is right, and that does happen over the next 1 to 2 years, and the rates do come down, that's going to be right around the same time someone closing right about now with a 2-1 potentially be doing a refi.
Exactly. Yeah, potentially doing a refi. So you have the downward pressure just coming by inflation getting more and more under control. The Fed's already come out saying they're not going to continue to aggressively raise the Fed rate. They're seeing the results that they want. They're going to let it ride for a little bit longer, possibly go up a little bit more as we go, but nothing as dramatic as what we've been seeing recently, because it's working. right? I mean, this is not the first time they've seen a spike in inflation. So, you know, they know the plan, they work the plan. While the plan is being worked, it's a little painful, right? Like rates are high and all the rest, but once it gets under control, it'll pay off. So
I agree with everything you just said, and I'm in that camp as well. I do think the rates will go up again, but I think it's gonna be very, very slight. So grab your crystal ball, tell me, what do you think the rates will go up to and when?
you mean what the rates will go down to and when? Is that what your question is?
No, if the rates go up again this year,
Oh, you mean the Fed rate or the mortgage rate? Sorry. Mortgage rate. There is just little to no data that suggests the rates will go up. I mean, there's always that outlying weird scenario, right? But everybody who I like to say is smarter than me, it's not a guess. I mean, there's a lot of data that gives a reason why. Again, inflation getting better, potential recession, these kind of things are all suggestive of rates continuing to go down. The more activity in the market, the better, right? Like the more mortgages that are being generated, it creates something called liquidity in our market, which also helps stabilize our market, which again brings rates down and down and down. So again, our hope is low fives by the end of the year, and that would be a very healthy market. That's the thing people don't realize. If rates are in the 2s and 3s, that's not healthy. That's not. I mean, as a buyer, yes, you'd love the rate to be at 0, right, or negative, even better. But that's not healthy. And that, you know, a healthy economy is good for a homeowner in a lot of other ways. It's just, you know, buying within your means, making sure you can afford it, making sure it works for you. And I know that's a complaint about Austin. It's kind of expensive, but it's kind of leveled out now. We're starting to see some better deals. We're starting to see some more affordable housing. And so if we can get them in there, that's the idea. So I haven't seen anything credible that would suggest rates would go up. So I don't even have an answer for that, because there's nothing that would suggest they would happen. So,
okay.
Yeah.
So let's shift just for a minute. You know, I work with a lot of investors, and I have a couple of questions for you about that. Wanted to give you a few scenarios. One would be that I have 4 people, they're all friends, they're not related, and they want to buy one property.
Yep.
They don't have an LLC or a limited liability partnership. They don't have anything like that. They just want to apply for a loan with you.
Yeah.
And buy this property. How does that work, just in a nutshell? And what would your advice be for those people?
So there's different strategies there as well. What I would be curious to know is how many properties in total is the goal, right? Like, so do they want to buy 10? Do they want to buy 1? Do they want to buy 20? You know, so that's the question, because, you know, if we can get away with only one of them being on it, that's better, because it keeps the credit free for the other 3 investors. So now eventually you have one, and then you can create this LLC, you can create this partnership, right? And that property goes into the LLC, and then the next guy buys one, it goes into the LLC, the next guy buys one, the next person buys one. And then now when they go to qualify, they really only have one property on their books, right? Each, but they have 4 properties total that are playing into this business. Now, how they make money from the business kind of depends on the rents that come in.
Sure.
Also, an LLC, you know, creates a little bit of a protection versus like if a renter hurts themselves or something. It's an insurance of sorts, right? Can also be a tax benefit depending on how many properties that you have. There's a few different strategies there, but in general, unless they're all just very worried that, you know, let me say this. If you're going into buying a property with 4 people, you better trust them. Right? Like, you know, if there isn't trust there and we're all going to get on it, because if it all goes bad, we're all going to be together on it. It's like, well, I would say in an ideal world, you would have a higher level of trust there, that, you know, all is going to be well. And hey, our ultimate plan is to own 4 or 5. So let's all go in and buy them, right? Like, you go get one, I'll go get one, you go get one, and we'll all put them together. Now, legally speaking, whatever that arrangement is wholly separate from the mortgage, right? But they can buy all together. So absolutely, we can have 4 borrowers, all individual borrowers, or we can do a single.
Sorry, one quick question I would have about that is, using the same scenario, as each of them would buy the homes with the assumptive 20% down, can 5% of that down payment come from each of those partners? And will the lender source it and approve that?
So if they're all on the loan, then 5% can come from each. If they're not all on the loan, so in a Fannie Mae investment property purchase, you cannot have gifts, right? So you can't have funds from anyone outside the transaction. It has to be from your own funds. So here's an example. Like, let's say I'm one of the 4 partners, okay, and I have a 401k with a couple $100,000 in it, and then I've got, some cash on top of that, whatever, like, checking, savings, money market kind of cash or whatever. So I go in, now I can't get money from my partners, okay, because I can't have a gift into the transaction if I'm the only one on it. Now, if I say do a 401k loan, so I pull the money out of my 401k, use that to purchase the house, and on the backside, they have some agreement where they're, funneling back over to him as part of their agreement with the partnership, like it's all going into that LLC. That's fine, but they have to be able to stand on their own merit when they purchase it as an individual. Otherwise, we'd have to add those other people to the account or to the loan. So
let's do a separate scenario. Let's say that I am, well, I guess it could be any number of people, but let's say that it's just me and I have an LLC.
Yeah.
Because someone told me to do that. And I want to start investing in homes, and I want to come to you and apply for a loan, and I want to buy that structure, that property in the LLC.
Right. Is that possible?
Yeah.
It is. So an LLC can purchase a home on its own merit, but the LLC has to have merit. Right. So a lot of people say, well, hey, I created my LLC last month and now I want my LLC to buy the house. I'm like, well, it doesn't work that way. Right. The LLC has to file tax returns, has to have a history. And when you get into LLC loans too, what's good to know about that is that is not going to be a traditional Fannie Mae style product. Right. Now, why do you get into Fannie Mae style loans? Because the interest rates are better. That's why. So a lot of people choose in general to just buy it, like individually qualify for it and then move the property into the LLC afterwards. And that'll give them the best financing terms and still accomplish the goal of getting it into the LLC. But what you're saying there is, well, I don't want to personally guarantee it, right? And that's kind of the same, well, it's along the same lines as the strategy that I was referring to as far as one person buying it if they can. So you don't have all 4 people tied up on one property, because then you all 4 have to, if one person wants to go out and do their own investing on the side of the partnership, which is likely, they have to count that property against them. And depending on whether the LLC is showing income yet or whatnot, it could be a drag. It could be a drag on their financials at that point. So
it does become a drag when you go to get qualified for an investment loan to buy another house, and you're at house, 7, 8, 9? When does it become a big problem?
You mean having that many on your like credit report as an example?
Yes.
Yeah. So there's a thing like, so it depends. If you get to more than 10, that's where it really starts from a guideline perspective. Fannie Mae starts getting like, okay, that's a few too many. But 10 financed more specifically. So a lot of people, like, as they build their portfolio, some of these houses will eventually get paid off, right? So that's the guideline, more than 10 financed properties. You can own 100, right? But if only 9 of them are financed, then you could buy a 10th investment property. Let me also be clear, if you're buying a primary residence, none of that matters. This is only in speaking with investors, right? I'm trying to buy another investment property. You can own 100, all be financed, and then go to buy another another primary residence, and that's fine. So
wouldn't it be prudent, and is this something that you would advise if I was an investor and let's say I did have a goal of having 100 properties, but I don't have a whole lot of money,
right?
How would I go about buying, let's say, 5 houses all at one time using one loan?
So that is more like a commercial style product if you're trying to pick up that many. And what you're talking about is cross collateralizing as well, where you own 5 and it's all at the same time.
Right.
Yeah, one loan for 5 properties, that's a different thing. So that's not going to be like a residential style loan. That's going to be more of a commercial style product, similar to like buying an apartment complex, or anything more than 4 units is considered commercial in our world. And so
To be
a
clear,
little
when you
bit different, but oh, go ahead.
when you say 4 units, you mean like 4 doors or a fourplex or a small apartment building that's 4 doors?
Correct. Yeah. So
Okay.
you have like a single family residence, right? Duplex, triplex, fourplex. But if you get 5 or more, that goes into the commercial space. Yeah.
What if I had 2 duplexes and that is 4 doors? Could I get one loan for that?
No, because again, that would be 2 separate properties. Now, if like I've seen times where you have a duplex that's split into 2 condos. Okay. So it was 2 doors now split into 2 separate properties, and the parcels, like the tax parcels, are split. The properties are split. These are 2 very separate properties and can be sold individually. That's fine. If you had 2 duplexes on one property, now it's a fourplex, right? There's 4 doors, and you can do that with one loan as long as it's all on the same property, and then you'd be fine at that point. So in a way, you can pull that off, but it just kind of depends on the setup, and you would have to merge them together, like legally speaking, merge them together, tax speaking, merge them together. So
Right. Interesting. Okay,
yeah.
that's good. What kind of advice would you give someone if they wanted to get an investment loan? Especially like some new people that come to me, they're ready to start doing that. They've never done it before, so they're a little bit nervous. My advice to them is always, let's not be nervous, in the sense that I'm never going to push them. I want their budget to stay under budget. Whatever they buy, I want them to love. I want it to be easy and low stress.
The biggest thing about investment purchasing, and I'll even extrapolate this to primary residence purchasing. I mean, I look at every transaction as an investment, right? Like I can't tell you how much money I've made off my primary residence living here in Austin, which is, whatever, partially luck in the most recent couple years anyway. But I mean, in general, it's just a wonderful place to buy real estate, right? That's why all these people from out of town come here to buy real estate. They come here to live, or they come here to invest, one of the two. But when you're buying any investment, and, again, be it a house, be it a market investment, be it whatever it is, you're looking for that investment to perform, right? So you're establishing a timeline. How long am I going to be in this investment? You're looking at how much cash you have to lay out to get the investment, and then how much does it pay me every year? So that's how I compare them, right? Like if I put money in a money market, let's go something really simple, and you make 0.25% on it every year, but you're guaranteed to make 0.25%, right? Like you're never going to lose money on that. High yield savings or a CD or something, right? That's where it's really low. And then you move into like real estate, and you say, okay, well, if I buy this, I expect equity growth of X percent per year, right? So I know I'm going to make this much on my money per year. You look at cash flow. Am I going to be able to charge more in rent than what my mortgage payment will be? And how to, does that matter, right? Like I've had investors that they don't need the cash, right? They don't need the monthly cash flow. They have income. That's not a problem. They're actually would prefer the equity on the backside to be all the money. So when they retire, this is their retirement asset. They're actually looking for tax shelters. So even if the property is negative cash flow, that's okay, as long as it's positive equity growth. And so it very much depends on strategy, and that's kind of what everybody's looking for. But, if you have your experienced investors, they're looking at stuff like that. If you have hey, I'm just getting started investing, buy a house that you're going to live in it for a couple of years, right? And go buy another one and rent that one out. But buy your first house with the full impression that I'm going to rent this out. I'm going to hold on to this house. And I'm going to rent it down the road. That's my first house I ever owned in Austin. Still a rental property with me today. Wow. And it is it's a great house. It's paid off at this point, right? And so it's doing really well for me, So that's a very easy way to get into it as a starter, just live in it, spend some time in it, live in it. And it might be something that needs a little bit of work, right? You buy it as a primary, you get in there, you fix it up, you're living there every day. And I don't know if your client is a handyman or not, but I mean, you can buy or pay for a handyman, or you can do it yourself, whichever the case is, and then move on from there. If you don't have the capital, because the investment properties start at 20% down, right? So you have to have equity when you very first start. And it makes sense to have equity because, as you know, if you did a zero down investment property, you're not going to cash flow, right? Like you're definitely going to be cash flow negative at that point. And if you didn't have any cash to put in it and you're losing money every month, that's likely not working well, right? So, speaking of 2008 and back in the past, you could do 5% down, stated income, no document investment properties and buy 10 of them at a time.
Right.
Wonder where the problem came in, right? Like when the market turned a little bit, it's like, uh-oh, these properties are terrible now. So the reason for these rules is that it kind of protects people from themselves in a lot of ways when it comes to investing. It's like, look, if you have the cash to do it, and they'll even incentivize more. If you do 25% down or 30% down, the rates get better, the cost goes lower, the cash flow gets better. Everything makes more sense at that investment level, right? Than doing 5% down or even the minimum 20. So, but yeah, I mean, it's all strategy, and it's all like, what you need in terms of your investment accounts, right? Do you need the cash or do you just want it on the back end? And if you want cash flow, that's a different, you're looking for a very specific kind of property at that point, a lot of times the multifamilies I find are better with cash flow.
Agreed.
Not as good with equity growth, but good with cash flow. So it kind of just depends.
For my clients, I'm usually going to ask them, are you looking to replace your job with income?
Mm-hmm.
Or are you looking for future wealth?
Right.
Because if you're looking for future wealth, I'm usually going to look for a house that I would call net neutral. It's not going to cost you money, but it's not going to it's not going to give you money. I would say,
what do you mean by that, right?
Yeah, 80 to 90% of my clients, they're looking for net neutral. They want future wealth. They're more interested in appreciation. What will this give me? And you want to do a reverse amortization schedule. I always like to talk to my clients about, how much longer do you want to work? Do you have 5 more years, 15 more years? And talk about how can we get that debt retired at that point? That's when you want money. Yeah.
I mean, exactly. And that's the whole thing. Like I said, there's tax strategies in there. There's a lot that goes into it. So, when you talk about buying a house as a primary, living in it, and then turning it into a rental, a lot easier of a strategy, right? Like it's kind of a no-brainer. I'm going to buy a house anyway, so I'm going to live in it. And you don't even necessarily have to make up your mind at the point in which you buy it. You're buying a house that can be a rental, but if you change your mind and you decide, now I'm going to sell it and I'm going to take the money and go buy another house, great. But if not, and you rent it, then great. So it gives you a lot more play. Options. You're not so sunk into it. If you're buying specifically a rental property, you want to make sure from day one it's lining up with whatever it is your strategy is and what you're comfortable with. Because I'm a firm believer in investing in the market as well. So I'm a stock guy. I'm a 401k guy. I like all that stuff. I don't have a problem with it. Real estate in Central Texas anyway has proven to be far more exciting in my career of investing, if you will. But that's just because it's a really stable area. So it's a good idea. But more so even than that is that it's good to have investments all over the place. It's good to have market investments, pre-tax, post-tax, real estate investments. It's good to have all the above because you're prepared for anything really, right? Doesn't really matter what happens in the future. You've got a bucket of money that you can pull from. So, but yeah, I mean, that's the thing here. It's just, it's a very solid place to buy. I mean, it really is. And, right now is kind of a weird moment, but there's so much strategy in buying houses right now. I mean, you really can get that sales price number down. You can get those costs paid for. You can do all that. You just have to be able to see the future of, I'm going to adjust that payment later. And that's with an investment property or a primary residence, doesn't matter, but that's going to play in both. So
I'm going to ask you, I just want to toggle back to someone wants to get an investment loan. Let's say they already own maybe 3 other investment houses plus their primary. Mm-hmm. I know a lot of times when you start jumping through the flaming hoops to work with the underwriter, they start asking for a lot. So I try to, and there's a lot of different ways to manage your investments and to keep track of them.
Right.
But I would say, just an overview, if you would please. I know that your underwriter is always going to ask for probably the current lease and bank statements. I always encourage my investors to have a different checking account for each house. It may seem like a lot of work for myself. That's how I do it. It doesn't feel like a lot of work. It helps my bookkeeper to know when I'm spending money on
Mhm.
any of the houses, they know where that money is going. It's going to that house.
Right.
But there's another thing that I was wondering if you could weigh in on. How is it calculated for the reserves when the underwriter is saying they want a month of reserves for every house or 6 months of reserves for every house? When is that a scenario, and how could anyone be ready for that? Because a 1 month reserve is one number and a 6 month
Right.
reserve is a much bigger number.
Right. Well, so let's first talk about what is 1 month of reserve. What does that mean, right? So you take your PITI payment, which is principal and interest, taxes, and insurance, right? Your full payment, and that's 1 month. Okay. So if they're asking for 1 month, that's how much you need. If they're asking for 3, you need that times 3. And if it's 6, that times 6. Now, when you talk about reserves, it's almost always going to be all properties except your primary residence. So it's only going to be rentals. And so, and to confuse you even more, if you'd like, sometimes it's a percentage of balance. So it's not always just months of payment. Sometimes it's a percentage of balance. And it kind of just depends like on your level of qualification, right? So like a good rule of thumb is if you have 6 months of reserve, 6 months of the payment in reserve, you're going to be fine. You're going to be just fine. And of course, if you have, more than that, even better.
Okay.
But if you were doing like a 30% down or, high credit, 30% down, everything is great about the loan, it might only ask for 3 months of reserves in some cases, which is, not going to be very much. Now, where you also get into it is like, think of the reasoning behind it, right? The why. It's if you're buying a house and it's every dollar you have and it's an investment property, you have no money when you're left.
Mm-hmm.
It's a little scary, right? It's a little like, what if something breaks, right? What if, and the reserves, just like when we're calculating rental income, the reserves is kind of a offsetting factor of vacancy, which is, kind of the number one fear of a landlord is having a vacancy. Vacancies are few and far between here in Austin. Don't get me wrong, but I mean, these guidelines are built nationally. So they're not just thinking about Austin, they're thinking about the whole country. And so in some areas, that's a bigger deal. So yeah, I mean, I would say if you have 6 or more, you're going to be just fine.
So let's say for argument's sake, that you do have several homes and a 6 month reserve on each of those homes times 6 months is a lot of money. It could be over $100,000. A reserve doesn't mean that you have $100,000 divisible by that many properties in each of those accounts. It could even mean that you have an investment account or a 401k or something else that equals that dollar amount to reserve, right?
Correct. Yeah. So in other words, now there's a calculation there. So if let's say you have $100,000 in a 401k, right? You can't go and pull $100,000 out and have the cash. Typically you're going to pay taxes, you're going to pay penalties, you're going to blah, blah, blah. So they usually take 60% of like a market style asset and they use that as a calculation of cash. So if you have 100K in a 401k, they'll use 60 of it as a calculation towards reserves. And of course, anything liquid, checking, savings, any of that, that's just 100%. And you don't have to pull the money either. So you don't actually have to pull the money down into cash. You just have to show that you have the ability to do it. That's really it. And then you'd be fine. Yeah. So that's one thing. And oh gosh, I thought there was a second question there, but that's the calculation of like reserves. You don't necessarily have to have it in cash. It doesn't have to be split by property. We're looking at total. So if you have one account, one checking account, it's got all your money in it versus you have 20 different styled accounts. It's just a different calculation on how we add it all together. Yeah. And when you talk about paperwork, I think that was your other, well, kind of in the beginning of that question anyway, is that we're always going to try to simplify it. Right. So sometimes I'll have a client that, they have lots of accounts with lots of money in them. Right. Okay. And so you have, 10 different investment accounts, but I only really need one of them. And that's going to show all the money I need and we're good. And so just give me the one and we'll be fine. Right. So, a lot of times it's, we try to simplify that as much as we can because of what you mentioned there, the paperwork requirements. And when you're doing investment account, when you get into jumbo loans more specifically, so you get outside of the conforming Fannie Mae style loans, which currently is, they just raised that, 726,200. So anything above that becomes a jumbo loan. They're more strict, right? So they actually ask for more stuff. Again, the why, they're giving you more money. So it makes perfect sense that they would ask more questions, right? So, so we try to figure out the easiest path. And we also try to be as bullet pointed up front as far as here's what we need, right? Sometimes you have the question like, well, why didn't you ask that of me in the beginning of the process? And it's like, well, I didn't even know you had that account, or I didn't even know you had that business until you provided the first set of a documentation. Then it spurred a lot of other questions, and so that can happen. I recently had a guy that owns lots and lots of businesses. And whenever we got into it, it's like, oh man, you've got 15 other businesses here. I need to understand how much you own in these businesses. I mean, it's good. It was a big jumbo loan, and it's tough. It's tough, but a lot of guys, and I keep saying guys and girls, but it's, if you have more complicated tax returns like that, 9 times out of 10, you have a CPA that plugs into you and is a very big part of your life, because they have to be. And so we just go to the CPA. I mean, we get on an email together and he says, yep, hey, give them whatever it is they need. Okay, great. Hey, Mr. CPA, here's what we need. And they just send it all over, and then we're good. So, yeah.
That's what I do.
Yeah.
All right. Well, let's wrap this up. I've got a couple of questions just so that anyone that has the pleasure of listening to all of your knowledge can get who you are. Your wife, how long you been married?
So it will be 20 years in August of this year. Yeah.
That's nice. Yeah. And you have a little girl and a little boy.
I do.
Yeah. How old are they?
So one turns 15 next month, the girl, and my boy's 10. So yeah.
Can't believe it.
Interesting age, having a teenage girl.
Yeah. And she's going to be driving.
Actually, we just signed her up for driver's ed and, all that stuff. And my daughter, what's funny about her is she loves to make me cringe. So she loves talking about all the things. I'm like, I don't need to talk about that with you. Like, Mom's right there. You can go have that whole conversation with her if you'd like. So, no, but I
saw you on Facebook. You were doing something with your daughter just recently.
Yeah, we go and play disc golf together at times. She really enjoys that. So we do that. When you have 2 kids, they just love any moment where they get you individually too, they don't ever want to share you. So actually that same day, my wife had a son date with my son. And then me and my daughter had a date too. So we played disc golf, and then we went to dinner and, all that stuff. And she's amazing. Yeah. Both my kids they're really sweet. The teenage girl thing, other than making me cringe all the time, she's super sweet still. So it's I feel pretty blessed. I can't imagine we don't get into some argument at some time soon here, but so far so good.
Maybe not.
Yeah. So, you don't have to deal with the teenagers anymore, do you?
Nope. They're all graduated and off to college, and
a whole separate set of problems you have now, huh?
Yes, a whole separate set of problems. Give me a little bit of feedback on you. I know you like to read, you're super smart, numbers. Where do you usually go when you're looking for that kind of data? Do you have like a favorite place that you're reading?
So, we pay for certain things here in the office, right? Like very industry related content or whatnot. And it could be anything from financial content to, more broad financial content to very specific mortgage related, or all the above. We also go to conferences. Even if you're talking about like credit repairs and different things within our industry too, it's always good to kind of know what's going on. You probably heard about medical collections no longer being counted against credit scores under a certain dollar amount and whatnot. So you're just always looking for, strategy, the tricks, right? Like there's a lot of things that pop out here and then, and they don't work for everybody, and not everybody needs them all the time, but down payment assistance loans and free money that's being given out there. Like, it's like, if you can tap into it, let's tap into it, right? I mean, because and your vast majority of people are going to do your conforming 30-year fixed rate style stuff. But especially right now when things are just unique, this is where we really thrive in all those alternative products. This is, where we're looking for more temporary, let's put a Band-Aid on it right now and then fix it down the road. But yeah, so we're, we, a lot of blogs, a lot of, paid for content, because as you say, I mean, like I focus on mortgages, but I don't know everything about inflation. I don't know everything about all the different
Right.
markets. And what's been interesting recently is it's kind of forced us more down that rabbit hole where it's really been an educational journey over the last, 6 to 8 months or whatever, because all that matters, right? You're trying to predict that, and you're trying to do what we're doing right here, right? Advise people on the things that we've learned so that they can get that, firsthand knowledge, that current information, versus waiting for the news to report it. And they're almost always going to be at least a month behind as far as reality goes, And so, yeah, I like all that stuff. It's been fun diving more into it, so.
I think we're all learning things that we never knew we were going to need to know.
Yeah. Yeah.
From COVID and post-COVID and recession.
Yeah. And that it's, we've been pretty blessed. I mean, as a generation, if you will, right? I mean, like a lot of previous generations, you had wars, you had, bigger wars, terrible wars, you had Great Depression, you had, crazy things that have occurred. And, COVID was kind of one of the first really big things that our kids and will talk about forever. We'll talk about forever, right? But it'll go in history as, a big deal worldwide that, they had to deal with. So, that's the thing. We've been lucky just in life, but in real estate, this area, extremely lucky, right? Economically speaking, in this area, extremely lucky. And I think we'll continue to be extremely lucky when it comes to all that stuff. So you didn't have to be perfect. You didn't have to necessarily know everything about the economy as a buyer, right? I mean, you just know it's a pretty safe spot to pick up real estate in, but now for you to get comfortable with it, even though it's still the case that you're going to be fine, it's good to learn about it. Kind of what we said, it's better to have more information, be less confused. That, that confusion, that lack of education sometimes breeds the frustration of real estate. And it's like, the more you know about it, the more confident you can be, the more expectations are being met, you're just more comfortable doing it. So, yeah.
Yeah, I'm always surprised. I know that you're running a big group over there. I've known you for a long time and I've watched the group grow, and yet you're so great with the people that you're working with. You always take the time to get on a phone call, to explain to them what's going on. And I don't know how you stay so calm. You always act very calm, like you've got all the time in the world, which I know is not true.
You don't see what happens as soon as I hang up the phone. No, but I try. And it's just being grateful. That's something I'm sure a lot of people are doing these New Year's things or whatever, but you talk about writing gratitude down every day, something you're grateful for, and even when times are difficult or challenging or whatever, there's just so much to, appreciate and love about life and the world and whatnot. And I think, well, especially when it comes to kids too, it's like, you just gotta, you gotta keep your cool.
Yeah.
I always talk about that with people having new babies and really young kids. It's like, man, if they get you to lose your cool, they win.
Yep.
That's how it works. So
good advice.
Keep it together. No, but that's really the thing. There's always opportunity. There's always good sides. There's always silver linings. There's, and that's what you're looking for, right? And if you can keep a calm, overview of everything that's going on, it helps you make better decisions all over the place, not just in real estate, but in life, right? And I try to do that, but don't get me wrong, I freak out every once in a while, so don't worry.
I've never seen it.
Right? Yeah, exactly.
Well, like I said earlier, cool people know cool people. So you're cool people, Josh. I like working with you. Tell anyone that's going to watch this, how can they get pre-approved or reach out to you?
So I think we're going to have this on, this is going to be on Facebook and whatnot. Yep. So you can always reach me through there. Just search my name, but office number is 512-279-1140. I think it's in my name. Oh no, it just says Josh Flores Supreme Lending. You can Google me. It'll pop up, teamjflores.com. That's another one. So there's several ways to catch me out there. Okay. So if you just remember my name and type that in and say mortgage, you'll find me. I promise you. So.
Probably true. Austin Mortgage, Josh.
Yeah, exactly. You'll see me. I'm becoming a dinosaur. I've been around for long enough, So.
No, not true.
So, but no, we enjoyed doing it. And I've enjoyed, obviously we've worked together forever. And yep. I'll say the same thing about, how you do your business and how real estate agents, there are good and bad, right? There are good and bad of every industry out there. And, finding people who care, finding people who will have those conversations, which will keep you calm, but educate you at the same time. Caring about your client, caring about their needs. I know that sounds almost basic,
Right.
but you'd be shocked to find there's a lot of people in the world that they just care about themselves, and they're just trying to get through a sale. And I don't think that's a good way to run a long-term business, is my point. Doing right by people, being, putting that positivity in the world and helping folks out, it all comes back around, and that's the reason when I refer people over to you, it's the same thing. I know you're going to take care of them. I know you're going to have those conversations with them, and they're going to be comfortable. And whatever that means, right? If they buy now, if they buy 2 properties, they buy 1 property, or they wait, whatever the case is, they got good advice, and that's the key. So thank you for doing that.
100 times. You're welcome.
Yeah.
Keep sending me business.
That's right. That's right. Well, we're not done yet. We got a lot more to go here. So
right. Yeah. We've got some record years to put in front of us, and we'll keep doing some deals together. And I appreciate your time today, sharing all of your wealth and knowledge.
Yeah. Thanks for having me. I appreciate it.
Thank you, Josh. Appreciate it. We'll talk to you soon.
All right. All right. Thank you so much.
All right. Well, you take care. Talk to you later.
Bye-bye.
Bye.